So with all of this in front of us, where should investors be focused, Victoria?
Yeah, you're right. There's a lot of information coming at us, not just today, but this week in general. And we add to that the JOLTS information, which I think is going to be a key component for us to watch in regards to what's going to happen with the labor market and what the Fed may be looking at. So what do you do with all of this? Well, I think you need to be a little bit conservative. With our clients, we're talking about having that diversification, that balanced portfolio right now. And we don't want to be out of the market, right? With longer term investments, you want to be in the market, you want to be able to take advantage, but I think you have to be very thoughtful about where you're putting your money to work in the market. We're not placing large bets in certain sectors, but there are areas that we like. We like healthcare. We've been investing in some of the healthcare space. We think you can do some of the tech, not necessarily that magnificent seven. You don't need to go in and start buying some of that, but other names that we own, like Adobe, we think there's places you can go in within tech and still be there, but you want to have exposure to other areas. The bond market, look at the yields. You guys have been talking about yields and where they are, the Treasury refunding announcement that's coming in the auctions we're going to see. You can get a 5% on a short-term Treasury. That makes sense in a diversified portfolio as well. One other thing, Diane, I think people need to look at in this type of environment, this uncertain environment, look at some alternative spaces that you have, whether it's something like a covered call strategy, whether it's something like an absolute return strategy that you can use. There's different elements, I think, because of the uncertainty and volatility in the markets that you can build in your portfolio.
What is the overall theme that you've been kind of taking away from this earnings season so far, Victoria?
Yeah, well, we always thought people were being a little bit optimistic with the earnings, but we look at where we are right now. We've got about 78% of companies that have reported that have had upside surprises. The interesting thing to this, Brad, is that even with 78% surprising to the upside, only 38% of stock prices are actually having positive reactions. Even if they beat expectations, the average right now is for the stock to trade down 1%. So it tells us that there's some concern over the earnings. You look at that phrase, weak demand, that is being mentioned at a number of times that is typically what you hear in a recessionary environment. So I think companies are laying out their guidance to say, look, things haven't been too bad. We're beating expectations for this third quarter, but we're really concerned about what's coming. We're concerned about the consumer. And so I think they're starting to lay some of that cautious guidance for the fourth quarter and for next year. And I wouldn't be surprised to see those earnings expectation numbers for 2024 come down. 12% just looks really high for us.
Victoria, is that, in terms of the earnings expectations, is some of this pegged to the slowdown that we're starting to see with consumers? And are you worried about the state of the consumer currently?
Yeah, so the consumer has really been kind of that underlying foundation for this economy. When we look over the last year, things that are telling us we typically should be in a recession, right? The leading economic indicators being negative for 18 months in a row, the M2 supply growth numbers, all of these things telling us we should be in a recession, but the consumer has been there. Now, disposable income for this year, the first 9 months of this year, was actually up 3%. That's really strong for the consumer. And because their net worth is moving higher, they're not having to go into the savings or put as much savings away as they have historically. So I still think there's some support there for the consumer. As you guys know, we're going into this holiday season. November and December seasonally are quite strong for the equity markets. So I don't want to count the consumer out, especially in the US. The consumer is always there to support the economy, but I definitely think we'll see some normalizing and some pulling back. Let's watch credit cards over the next couple of months. If we see credit card spending and revolving debt increase dramatically, then I think we have to look at concerns for the consumer in early 2024.
There's a few things that play with the consumer for sure, and we're going to get more of those retail companies that report towards the latter half of this earnings season. But from what you've heard from some of the CPG companies, even from the food and beverage companies that have all, in some cases, needed to pass along price to the consumer. And in different instances, we've seen where that price is realized and where there's been a pushback because volumes might have taken a bit of a hit. All that considered, is this a consumer right now that is showing any signs of at least recession fatigue in how much it's been talked about, how much it's been a consideration or a concern of a soft landing or a hard landing or a shallow recession or a mild recession for the better part of a year at this point?
Yeah, it's definitely been the hot topic of conversation, and it's all tied to the strength of the labor market and wages moving higher. We've seen wages start to moderate a little bit. I mentioned when we first started our conversation, the JOLTS number coming out. Let's look at that quits rate. The quits rate actually leads the employment cost index by a couple of quarters. So if we see quits start to slow down, that should tell us that maybe we'll see wages come back a little bit as well. Again, all of this feeding into the strength of that consumer that we have. It has been a topic that we've been concerned with because it's been, I think, what has kept us from having the recession. Now, pricing power of companies, as you mentioned, has been strong, but as inflation starts to come down, although it is coming down slowly at this point, as inflation starts to come down, those companies will lose some of that pricing power. We have to see whether disposable income continues to hold for the consumer, allowing them to spend, or whether they start to pull back a little bit. That story is still something that we'll have to watch and see what happens.
And Victoria, really quickly, before we let you go, I want to ask you, obviously, there's a big focus on the Fed today, but a lot are looking beyond what actually comes out of today's meeting. What's your expectation? Where are you trying to read the tea leaves beyond today's outcome?
Right. Everyone's trying to guess what's going to happen in December. And I wouldn't be surprised if the Fed actually stays on hold through the end of this year and then wants to see kind of how much of the 525 basis points works its way through the economy in this last quarter of the year. And if they're going to hike again, which I actually think they probably will, I think we have to look at maybe early 2024 for that. Be listening for that idea of duration of the pause. And I think that's going to be a clue for us as to whether we get another hike in December or whether it moves into the first quarter of next year.